Well, hello, ladies and gentlemen. Welcome to this discussion, which looks at the defined contribution side of the pensions universe. My name is Mark Dunn, and I'm the editor of Portfolio Institutional magazine. I'm going to be your host for the next hour. Before we start, just let you know that this conversation is being recorded and it will appear on our website, portfolio-institutional.co.uk. So make sure you're smiling at all times because you never know who's watching. And an edited transcript will appear in a special supplement we have on defined contribution. A good place to start, of course, is the introduction. So if you just go around and give us a few words of exactly who we are. Julian Halfon, if we could just start with you.
Yes, thank you, Mark. Julian Halfon, I'm the head of pension and corporate solutions for BNP Paribas Asset Management.
Okay, Jeff.
Morning, everybody. Jeff Cheetham, internal investment advisor at the pension regulator. Previously, though, sitting on many of your sides of the table in the asset management industry for many years.
Oh, so you've crossed over to the dark side, have you, Jeff?
I've crossed to the dark side.
Oh, okay, Anakin. Victoria.
Morning, everyone. Victoria Panormo, Senior DC Investment Consultant at Hymans Robertson. Been in the industry for about 15 years, advising DB and DC schemes, but for the last 7 years have focused solely on DC clients.
Thank you. And Daniela.
I'm Daniela Silcock, Head of Policy Research at the Pensions Policy Institute. We do research into state and private pensions policy and all sorts of different policies that affect people's retirement.
Gotcha. Keith?
Yeah, so I'm Keith Sully, and I head up pensions for Intercontinental Hotels Group, which is a large hotel company operating brands such as Holiday Inn, which you'll no doubt have heard of. And we currently have pretty much only defined contribution pensions around the world, having bought out our UK and our US DB schemes.
And Philip?
Hello, Philip Smith, DC Director at TPT. I'm responsible for our DC Master Trust, and I've been in the industry over 20 years. Been with TPT for about 3 months, probably spent less time in the office working for TPT and more time at home now, but anyway. Prior to working for TPT, I spent my career in consulting, most lastly with PwC.
Gotcha. And Stephen?
Hiya, Stephen O'Neill, Head of Private Markets and Investment Proposition at Nest. Been building up the scheme's investment policy for the last decade or so, but more recently moving into the implementation and investment research, supporting the move into illiquid assets and private markets.
And last but not least,
morning. Name's Julian Line. I'm the Chief Commercial Officer at Newton. Been in the industry for 25 odd years, and until the travel ban was based in New York, but currently based in Billericay.
Gotcha. Thank you, Julian Line. Thank you. Thanks for that, guys. Just good to test all your microphones are working. That's good. Now, more and more defined benefit schemes are no longer admitting new members. And with the introduction of auto-enrolment, the influence of defined contribution in the pensions market is growing. Indeed, assets managed by DC funds globally grew at almost twice the rate of those managed by DB schemes in the past decade. So that just shows exactly how things are changing. So this is said to be quite influential in the retirement savings world, but are savers engaging with their pension schemes, and how will technology and regulation, what role will that play in the evolution of these schemes? Actually, Keith, we can start with you. The Holiday, you're the head of a scheme to do with the travel business, and we know that in the world living at the moment, that sort of industry is taking a bit of a hit. Are you worried about maybe the long-term damage that the corona crisis might cause the pensions industry?
Yeah, so it's probably still too early to talk about long-term damage to participants' savings. but I think we've all lived through similar things in the last sort of 20 years. We've probably had 3 once-in-a-lifetime events: credit crunch, dot-com bubbles, and now this. And all of those, you always get the worst of kind of both worlds, where people look after their cash flows. So cutting savings is an obvious first step to doing that, and they're doing it at kind of precisely the wrong time when markets are heading downwards. So yes, we've had experience of it. Yes, that kind of thing does happen. It is detrimental, but history has sort of taught us so far that there is a way out of it and a way through it, and people, inertia helps. People work their way through it by just kind of not looking at their plans. But yeah, some people will look at it and will reduce contributions in order to kind of increase their sort of take-home pay and cash flow.
Okay. And Philip, how are you guys reacting to the situation at the moment?
So we've seen our kind of, I guess, both employers and savers to date be remarkably resilient. Seen no drop in contribution levels, contributions being submitted in the same patterns as they were before the crisis. No drop off in member contributions. In fact, lower levels, I guess generally lower levels of activity and calls, certainly in the early days of the crisis. It's picking up a little bit now, and very limited switching as well. So we were kind of on the front foot with our messaging right from the get-go around the importance of taking a long-term view and not panicking, and following a lot of the good guidance the regulator was putting out at the time. And so to date, I think that seems to have worked. Obviously, it is still relatively early days, and I think one of my concerns is how this plays out over the long term, because I don't think any of us have seen the true economic impact yet. So I guess feeling that people are have taken it in its stride at the moment, but I guess some concerns for what might play out over the rest of the year.
Okay. Julian Halfron, with the conversations you're having with some of your clients, are they concerned about any long-lasting damage?
Yes, they are quite concerned. Of course, there are a couple of different behaviors depending how you've invested. When you invested in liquid assets, the early stage was the credit spreads going really high and the equity market going down, then recovering some of the shock. Well, you always have that question, what do we do next? And I've seen this twice, like most of you before. And if the first 2 times are any indication, nothing will happen next. But on the liquids, people investing in liquids, I think I've already learned some of the lessons, what happened in the past. And they're already sort of moving into an idea that the liquids can at least, in a short term, avoid the volatility of what you're facing in the market, and also maintain a sort of reserve, sort of stability of the investment, which reduces the immediate need of additional contributions. So the question that's where I discussed with a couple of our clients, DB and DC, interestingly, they were pretty similar. On DC side is more the members that have started to think that maybe evolving towards something which is more liquid could be safer over the long term. And on the DB side saying, well, maybe this time we should move towards something which looks like CDI. So we had both types of pension funds coming to us with finally sort of some reasoning that will show that they've learned some things from the past.
Gotcha. And Julian, what sort of conversation are your guys having with institutional investors about this?
Yeah, I mean, I think a number of the issues have been addressed already. I think one of the really interesting developments is not only in terms of DC members, how they react today, is what are the implications on the markets of some of the changes that are coming through, for example, on dividends. And if we think about retirement, if we think about drawdown, if we think about DC members as they near and at and through retirement, what does the investment environment look like in terms of generating returns? And I think we haven't quite seen how that plays out yet. I think that is a new environment. I think certainly the question is that a long-term issue? I acknowledge that the question long-term damage. But if you combine that with the issues, we had the Chancellor talking last night about the economic effect on the UK and globally, for example, we think about the individual implications for people that have lost their jobs, unfortunately, or being furloughed, and then you wrap into that the implications, potential implications in terms of the dividend environment and the market return environment. I think it's absolutely clear that there is a risk that the COVID situation will have an impact in not only the short term, of course, but potentially into the medium term and the long term. And I guess if I wrap that up into the behavioural finance side, do people seeing their pension valuations fall over this period? Does that put them off and act as a disincentive to save? And those combination of factors are clearly quite challenging in terms of the environment, the economic environment, and also individual savings.
Thank you. Daniela, we've heard that DC is growing at a faster rate than DB at the moment, but if things do change when we come out of this, so more and more people perhaps are out of a job, earning low wages, a low career progression, sure, that's going to have a long-term impact on the size of the DC market.
Yeah, absolutely. But I think it's also worth remembering that auto-enrollment has some clever policies built into it. And one of the really interesting ones is the policy of re-enrollment. So we will see people stopping contributing because they might have lost their jobs, their earnings might have gone down, though there are obviously in place some different policies to help people who have been furloughed. But because people are going to be re-enrolled whenever they get a new job, or after every 3 years if they stop contributing, and because we're continuing to see fairly remarkable levels of inertia, I do think over the long term we will see people's savings pick up again. And also, let's not forget that the 8% minimum of band earnings contribution level that we're seeing at the moment is likely to go up in future. So in terms of the long-term policy of auto-enrollment, I'm feeling fairly positive. I think where this is really going to affect people is if they're fairly close to retirement, or if they've just retired, but they don't have an annuity or a DB pension. I think this is where we're going to actually see the level of assets fall and potentially not rise again, particularly as we know people are going to often react by withdrawing money and trying to put it somewhere else that they think is safe, and end up probably selling at quite a low point. So it's really the at and in retirement market where I think we're going to see long-term asset over time.
Yeah,
gotcha. And Stephen, at Nest, I mean, have you guys made any sort of contingency plans for the times we're living in, for maybe when we come out of this crisis? Is it still business as usual for you? What's happening?
Well, it's certainly business as usual. From a policy and process point of view, I mean, I guess the impact that we've witnessed over the last 6 to 8 weeks has been obviously significant volatility in our portfolio, which means that a lot of the work we're doing at the minute is focusing on keeping everything rebalanced to appropriate and target weights. But we're doing that against a backdrop of a certain amount of uncertainty in terms of the contributions that are going to come in from members, because obviously the Nest membership are particularly exposed to the economic effects of COVID. The government's income replacement policy for furloughed workers has obviously dampened that somewhat. But it's still too early for us to really see how that will shake out. So we are, I guess, being slightly more cautious about funding things like liquids today than we might have been if we were having this conversation in February, because the number one priority above all else is to make sure that our members broadly have the right balance of growth and defensive assets. And as asset prices move around wildly, and we don't know quite what contributions are going to be coming in from one period to the next, that normally fairly routine challenge has become a little bit more day-to-day and hands-on, I think is the way to characterise it.
Gotcha. Okay. And Victoria, what kind of conversations are you having with your clients?
Well, I'm hearing all of this, and I just wanted to try and put a positive spin on things if I can, because I think some good might come out of this. So I think once employees are back to work, somebody mentioned career progression earlier on, and I think that will be on the minds of the ambitious, and where they are in their pensions contributions and adequacy for pension provision might not be top of their list. But I think we could probably use this time as a way to engage with members. So I think contributions generally had been too low for members up until now. Obviously auto enrolment has helped with that, but I think generally across the piece, with maybe the exception of low earners, maybe people aren't saving enough. So maybe we'll be able to get members to look at what they need now they've maybe had a dry run attempt at what it's like to be retired. Maybe we can seriously get members to engage and think about what they should be saving versus what they are saving.
Okay. Point. And finally on this point, Jeff, everyone seems to be drawing up a plan, whether it's politicians, businesses, about what happens post-COVID. Are you the regulator anticipating any long-term disruption, and how are you reacting to that?
Well, I think as we've heard, the position's unfolding. What we've tried to do is to provide as much flexibility as possible so far in the way that we're going to be implementing the regulations, and we're looking obviously to take a proportionate approach, recognising the challenges that employers have got. I think we're seeing what people have already discussed, which is there seems to be a high level of resilience at the moment in terms of contributions, etc. But I think we're in an early phase of this. So I think our position is we're just watching the position unfold. We want to keep flexible, and we'll try and give as much and doing as much as we can, provide information on our website through the guidance to help people navigate through it, and whether that's on issues such as the re-enrolment process, the reporting processes that companies have to pursue. We're trying to be pragmatic.
Gotcha. Okay, thanks. Thank you, guys. Now, Stephen said that he's a little cautious investing, especially in more liquid assets, but with the volatility we've seen in the investment markets, is this a good time to maybe pick up a few bargains? And open questions. Anybody want to say this is a good time to start reinvesting?
Shall I qualify my statement? First? So I don't think I want to stress that we're not cautious about illiquids because of relative value, or because of any particular view as to whether or not in the long term they are worthwhile investments. I think what I'm was trying to get at is that managing short-term liquidity and rebalancing in volatile markets is a temporary priority, and obviously if sticking large amounts of money into a liquid portfolio makes that challenge somewhat more difficult. That is only a temporary situation, however, and I think within the next 3 to 6 months we'll see markets return to a somewhat more, if not normal, then manageable level of volatility. And then I think we will be back to business as usual when it comes towards, funding our infrastructure, private credit portfolios for the long term.
Gotcha. Okay. And Philip, what about yourself? Are you guys sort of hanging back a little bit, or are you looking to see what's about at the moment?
Sorry, someone coughed. I didn't hear the question.
No. Are you guys at the moment, are you looking to see if you can put some money to work, or are you hanging back for a few months to see how the market lies?
No, I mean, I think it's kind of business as usual for us at the moment. We have dialed down equity a little bit, so slightly more allocation to short-term credit. But at the moment, we don't have kind of a large infrastructure or private equity allocation. So given our scale and our size, we're about 1.6, 1.7 billion. I think that's something that's on our radar for the future. But right now, we're kind of we're managing in a sort of a traditional DC type environment and just a slightly lower equity allocation.
Okay, no problem. Julian Line, what about you guys? I mean, you guys are putting money to work for institutional investors. Has anything changed for you in terms of that?
I think Mark, I just wanted to kind of take your question, take it in a slightly different angle, if I may, because I think connecting your question to the other point that was raised about COVID and maybe picking up something that Daniela talked about, I think what the current environment has given us is a reconfirmation about the importance of making sure our default investment strategies are fit for purpose. I think it allows asset managers, asset owners, governance, consultants, to really remember that the level of apathy that a number of us have talked about in terms of the DC membership, and then looking at what our default strategies are looking to achieve, and I think it ties into the importance of timescale. I think it ties into the importance of where people are in their working life, and I think to answer your question more directly, in an appropriate lifestyle strategy, default strategy, where you've got the benefits of long-term investing, clearly, if you've got a long-term time horizon, any part of market volatility or drawdown as we experience creates opportunities. I think it's important, though, linking into again points that have been made. It's when people are in the wrong strategies with short time periods that really the risk at the moment and the risk of default strategy and the risk of being in the wrong asset classes really comes to bear. So I think in long-term strategies, long-term time horizons, clearly opportunities to be had if you're able to suffer, if I can use that word, the volatility. I don't think we're through this, as Jeff said. I think it will unfold in the coming months, but there's certainly opportunities for people with the right timescale. And then clearly DC, but for a lot of people, offers a long-term timescale. So opportunities to be had if appropriate.
Gotcha. And Julian Halfon, is volatility your friend at the moment?
Well, depending what you invest in. If you go to liquids, and I would like to mention a couple of things on liquids. First, I think there are opportunities, because if you look at the investment grade spreads on the liquid side, they haven't shot up that much, less around 100 basis points. So you still have much better deals in illiquids if you compare with the liquid market. So if you look at very safe, high quality investments, illiquids can still offer good deals. At the same time, we don't know, as Julian Line mentioned, we don't know if there's going to be a second wave or something else that can make things a lot worse. So that is not a quite statement. Now, when it comes to liquid assets, I mean, looking at the volatility on the equity side, it shot up really high at first. I mean, look at the VIX, I think it reached 80 or something like that, then went back down quite fast. If you had, and it's less the case in DC than in DB, if you had a protected equity investments, something with, I don't know, either futures or options, you probably were very happy. And volatility was your friend. I mean, you really potentially rode a very nice wave with high value of the options or the futures. That would have been really good. If you're not, you had a bad ride and you're still down probably 20%, and volatility is still affecting you in a non so positive way. So it will depend how you structure your investment to start with. I do believe that on the liquids, you're potentially better off than in liquids for the moment because you suffered less, and the losses on the high quality investments have been a lot less and not that marked. I mean, 100 basis points for of spread for investment grade is not that high because it also includes some BBB, which is pretty low in reality. In equities, I would say will really depend how you structured your investment, and could be that you suffered a little bit.
Gotcha. Okay. Changing the conversation now into communications. Keith, are you guys having to communicate a little more with your members during this time? Are they a little worried? Are they contacting you? I mean, how's this working?
Yeah, so we're, as usual in these times, having actually very little contact directly from our membership. Our third-party administrator has had a minor uptick, but nothing significant. And it's always a difficult balance to communicate, because from kind of an employer and also the trustees with governance perspective, you don't want to act as a disincentive through your communications and deliver kind of unintended consequences by talking about risk. So what we've tended to do and what we've done through this so far is to stick to our normal communication timelines. So we issue our annual statement on the same time that we normally do. We issue an annual newsletter when we do. We also utilise an internal kind of employee forum. So we have 3 member representatives, kind of basically a pseudo employee trustee section. We use them as a sounding board, as a sort of a typical member, and again, it's sort of they're clued up enough to know that this is probably low down the list of things that they lose sleep at night over, and yeah, they're happy for us to communicate in the way that we do, to say the usual things. So talking about sort of pound cost averaging, talking about the types of assets that you might want to invest in at a particular life stage, but going kind of no further than that, and not specifically addressing particular economic events.
Okay. Victoria, we go to you first.
Yeah.
What do you do? I assume your clients, are they the same? They just keeping it business as usual, or are they putting out extra special sort of bulletins to their members?
In terms of communications, I think we're seeing schemes adding wording to websites and call centre scripts and what have you, but we're not necessarily seeing schemes mailing letters to members about the impact of COVID, directly, to be honest. I think because, as somebody said earlier, it's a bit too early to tell what the impact will be. And I think also I agree with what Keith was saying, is that, when you're communicating with members, you've got to proceed with caution, I guess, in case you awaken the beast. Members making their own investment decisions tend to result in members selling low and buying high, which I don't think is an investment strategy. I've heard many IFAs advocate. But for me, in terms of communication, and this is what we say to our clients, is member segmentation is key. So those approaching retirement will have very different concerns to those who can withstand the volatility, and say it's a 20-year-old that's just joined the scheme, for example. So segmentation has never been more important in terms of communication, I'd say.
Okay. And Jeff, speaking as a regulator, are you happy that it's just business as usual on the communication from members?
So yeah, a couple of points really. One is that I think BAU is important give members reassurance that everyone's in control, and the providers of the schemes are comfortable and confident with what they've got. I think Julian made a really important point earlier about we're going to see how robust a lot of the default strategies are. There are some areas that we're worried about though, and the areas that we're worried about, I suppose there's 2 things spring to mind. One is that when members actually see the extent of the drawdown on their pots, will they make hasty decisions? So we're very, very keen that scheme members avoid hasty decisions, and that trustees are alert to the risk that seeing major drawdowns may do 2 things. One, it may may result in members deciding that they're just going to cash in their chips at entirely the wrong point in time. The behaviour being that actually it's better just to have my cash under the bed, so to speak. But the other area that we're very alert to is that this is a sort of an environment where the scammers start to emerge, and we're very nervous about the prospect of people being exposed to scams, and so individual members receiving these, fantastic offers from people who are going to, return their funds to where they were before the COVID drawdown very, very quickly through this fantastic investment idea. We just need to be alert to all of those issues, and I think as a regulator, unfortunately, we see a lot of this. And so we're really keen that there is messages of reassurance, and that there's very much a message to members to not do anything hasty, and to review everything very, very carefully, and that they are directed, if not to, if trustees don't want to take all of these questions, but people are directed to Pensions Advisory Service, Pensions Wise, directed to areas of support, just to avoid people making uninformed, hasty decisions.
Gotcha. And Daniela, of course, scams in the pensions industry has been well publicised for years, not just because of COVID. Are you guys at the pension policy issue? Are you guys happy with this level of alertness with schemes that you're seeing?
I think the short answer
and the support they're giving their members?
No, especially not members. I mean, since freedom and choice or the pension flexibilities were introduced, we've seen a major uptick in the level of scams. And this isn't just for DC investors, it's obviously for those with DB pensions who are being encouraged to transfer over and then put into fraudulent investments. And then again with COVID, there's been another uptick, even trying to get people who are under the age of 55 to try to take their pensions out early. So it's a really serious issue. The problem is, this is, like so many things with pensions, working very counter to people's behavior, their behavioral economic patterns. So the sort of instinct people have when they're seeing a crisis like this is to take their money out, put it somewhere where they think is safe, and that's exactly the wrong thing to do. We just actually published a briefing note with a big sign saying keep calm and carry on, trying to make the point that any decision made in haste is going to be fairly risky and dangerous. But we're working against both behavioral economics and scammers and fraudulent behavior, who unfortunately scammers are very, very good at addressing people's concerns. I know that the regulator, the government are all working really hard to try and stop scammers, but I think the scammers are working really hard as well. So that's all quite negative, and all I can say is we really need to keep up the effort, especially because over the long term, we'd like to damage trust in pensions as little as possible.
Gotcha. Okay. I'm bringing back now to more the investment market side of things. The fee cap, is that a help or a hindrance when it comes to generating returns? John Halfron, you're an asset manager. What do you think?
Peter, the tough question to ask. Well, actually, the fee cap is not that low. So it, actually, depending what you're investing in, for liquid, it's potentially a little bit complex to manage. But then again, we've done it in a number of cases. It's not that much of a problem. For liquid, I don't think it's a problem at all. I mean, it's high enough to allow even sophisticated strategies to be implemented. But I do believe. But I know in that statement, I know all of you must be thinking, well, it's not me, somebody else. And I think that sorry, it's annoying. So it's fine. It's coming back to Daniela's point about scams. I think the fee cap as it is good to maintain some sort of transparency and on the market, but I don't think it's enough to protect DC members from scams. But it's one of the issues is that anything that's cheap is not always good. This is one of the conclusions. But so far as we're concerned, I don't think it's a problem because it's high enough. But I do believe that it should be the fee level should be always proportional to what you expect of the investment, and that will potentially also protect DC members if they're forced to look at more details on what the investment opportunity is really about, and that should I think they should help a little bit limiting the possible catastrophes. I fully agree with her. In periods of stress, we've seen in 2008, 2009 with Madoff, and before that, in the 2000s with early 2000s with the tech bubble and all the incredible offers that people were receiving with tech stocks. That if you only base your reasoning on one dimension, the fee level, you're probably oblivious to what's coming later, to the real problem.
Gotcha. And what about Newton? Is the fee cap being a help or a hindrance?
Speaking at a personal level, first, I've thought of the fee cap because I think the biggest challenge DC has is getting people to save at all. And I think anything that can give people the reassurance that they're not going to get ripped off is important, and I think it's made the industry deliver value for money, or try and deliver value for money, and be very cognizant of using their fee budget. I think just a couple of quick points. In the US, however, it's probably gone too far, and they don't have a fee cap as such. But if you look at all the surveys by consultant firms, the biggest threat when speaking to 401k plan sponsors is the threat of litigation, where plans are being sued by their membership because they have a fund at 5 basis points, and the one down the road is getting 3 basis points. And I think that's probably not ideal, maybe, if I could put it that way. So for me, I think the fee cap allows for people to have some confidence that the fee that they're being charged, I think it gives schemes a clear sense of hopefully delivering value for money. But just to reiterate a point, and I would say this, wouldn't I? Low cost does not equal the best outcome for members, and it's that balance, it's that value for money, and understanding when you've got a long time to go to retirement, you can absolutely probably just go for passive fund options at low fees. But as you get nearer, try and use that fee budget sensibly to deliver the right outcome for members at the right time. But I think as a concept, we are supportive.
Gotcha. Stephen, Nest, do you guys welcome the fee cap?
I mean, this is my favourite topic. Nest and most of our peers sail well below the fee cap. So the 75 basis points, I think, is by and large a red herring for the purposes of automatic enrolment, defined contribution. The challenge, I think, so it's 75 basis points, just to echo what Julian said. 75 basis points is certainly more than enough for any default strategy to deliver a very sophisticated and diversified investment solution. The challenges that arise, I think, are in the private equity space, where custom and practice is to have performance fees and so on. And as a sort of point that I always like to labour is that, notwithstanding the actual level of fees in the private equity or infrastructure equity space, it's the structure of annual management charge plus carried interest that doesn't really fit into the calculus of the charge cap that poses a challenge. So having the sort of the structured payoff to the manager is challenging within the charge cap formula, ignoring the actual level of it, the 75 basis points or whatever it is that your scheme charges members. So for that reason, we look for managers who can accommodate a total expense ratio basis, but that obviously narrows the field somewhat, because a lot of private equity funds, certainly the best ones, are well oversubscribed, and they're not necessarily minded to overhauling their business model to accommodate the DC market just yet.
Gotcha. Okay. And Philip, what about you? Is it delivered value for money, do you feel?
Yeah, I do. I think it has. I mean, the fee cap has never been an issue for us. We're well within it, and I don't think we've felt that it's hindered our ability to deliver good default solutions for our members. I mean, I suppose in some ways I have got a little bit of the opposite concern around the broader DC market, and a little bit of a race to the bottom on fees, and probably a feeling that might hinder some investment innovation if the consulting community's kind of practice is always focused on the lowest possible fee. I know that it's been a subject for debate in the market for a long time, but I don't sort of sense any kind of trend yet that there might be a move away from a price-driven selection process, more towards looking at the overall quality of the investment solution. So I guess that would be my one sort of concern around the impact that the fee cap has had and the way that the market has responded to it.
Okay, gotcha. And Keith, has this been an issue for you?
Yeah, so I found myself agreeing with a lot of people throughout that. So yeah, no, the cap provides the reassurance to the membership, and yes, it's not a hindrance to us to construct a sensible and appropriate lifestyling option as our default, which is what we've done. And it's sensible at the level in the UK market. And interesting to hear Julian's perspective from the US. So I sit on the fiduciary committee for our 401k, as well as being obviously looking after our UK DC plan. And yeah, we see far lower fees for our 401k. We couldn't get anything in the UK for less than 10 basis points like we see in the US 401k, and that's a combination of the market, and also that's a very old scheme that's kind of $1 billion scheme, so it has the purchasing power. So the UK market, where it is right now in DC, it's kind of fine and does its job.
Gotcha. And finally on this question, to Jeff, the fee cap, has it delivered value for money as the authorities thought it would?
So I think it's really interesting to hear everybody's views on it, actually. It's the first time I've heard such a cross-section of views since I sat on this side of the table. I think that Phil made an interesting point about we need to be wary about a price-driven market. And there's clearly parts of the DC market that are much smaller than those represented around the table here. And it may be more difficult for very small schemes to get innovation into their investment strategies than it is for larger schemes. But the reality is we wanted to provide transparency. It was important that people who are basically being defaulted into schemes, that they have the transparency and the reassurance of value. And we think it's achieved that. No doubt questions will be raised from time to time about what the right number for the charge cap is. And I'm sure that will be revisited from time to time. I think Stephen made a really interesting and important point that we're very keen to encourage innovation. We're here to talk about illiquids, for example. But the issue of performance fees and carried interest are very live. And I think Stephen made some really important points, and that complexity will challenge potentially the fee cap in certain default arrangements. So we need to be wary of that. It was interesting when we conducted a review of the market, we weren't critiquing the quality of investment strategies, but I think there is a view that cost is driving a lot of design rather than investment innovation still. And that's something that I think we all probably need to look at, not only from a regulatory perspective, but also from a market perspective. That this is about value for money, not about cost. And we probably want to try and avoid the situation that Julian described that's now arisen in the US, where people are arguing over 1 or 2 basis points. That doesn't sound a very healthy place for us to go.
Gotcha. Okay. We have got quite a time's pressing on, and we do have other issues to raise. So I think we'll move on from that. Julian Line, are master trusts serving members from an investment perspective, or are they just too focused on, as we heard, their fees and administration?
I think it's an interesting question to ask an asset manager, and I think if I can give you kind of my sense of perhaps what the opportunity that master trusts offer, I think and a number of points have been raised already. I think master trusts, by the nature of their scale, really have an opportunity, and many are, including those on this call, really kind of making the most of taking advantage of that scale, bringing in, to Jeff's point, some of the smaller schemes, perhaps not all, but some of them struggling to be able to have innovation, to use pricing power. And we really see the master trust as being a a really good potential opportunity for bringing the best in DC, be that in the governance, be that in the investment innovation, be that in the pricing. You know, what I would say, and I'm conscious Keith's looking at me now, you know, it's not for everyone, you know, and obviously there are a number of really good large schemes that exist, and indeed some great small schemes that exist. But I think as a DC solution for many, you know, Master Trust with their scale, you know, really kind of give a good chance of delivering a good outcome for members, and actually innovate on the investment side, on the proposition side. So yeah, I think we're still relatively early in the Master Trust world. I think Nest have done some really great things, and I have been consistent on that, Stephen, I think. So yeah, I mean, we're positive on Master Trusts, but obviously there are other DC arrangements that deliver for their members equally. But yeah, positive.
Okay. Keith, are you guys perhaps too focused on maybe admin, VCAP rather than investment perspectives?
So we have a single employer trust. Our UK plan is about 80 to 100 million ish, and has about 1,500 members, 50-50 active deferreds or thereabouts. So we're sort of a mid-sized UK DC scheme. The thing about Master Trust, and they have always been on the back of our mind since the outset, and we've seen and continue to see the progression in the market. There was obviously a lot of them to start with, and we're dwindling down to a kind of a sensible number, and using, as Julian says, their size in a better way. So we continue to monitor the Master Trust market, but I think you need a bit of a context of IHG. So we, as a business, our operating model is largely franchised. So we don't have the employee base that you might think. We don't have the hotel employees who work for us. We have actually quite a small number of generally corporate-based, generally high-earning, generally young workforce in the UK. So the scheme that we've set up, we feel kind of meets that demographic, and we don't think currently the kind of large one-size-fits-all of a Master Trust is where we want to head. Potentially for kind of decumulation options in future, or even for as and when employees leave us and their deferred pots stay with us, it may be somewhere where it's sensible for them to accumulate, so it's a single source. But currently we don't see the rationale to make the jump yet.
Okay. Time is pressing on. Does anybody else want to come in on this particular question about if schemes are too focused more on admin rather than investment outcomes?
I think as a Master Trust, and one of the kind of ones that's got scale in the UK market, looking around and having worked with them in a previous life, I'm not sure that I would necessarily agree with that. I think that most Master Trusts are pretty well governed. I mean, Master Trust authorisation has definitely been a force for the good and shaken the market out. If I look at what we do, our trustees are very rigorous in the way that they govern the scheme, and think very thoughtfully and carefully about the investment solutions and the service that they deliver members. So I think, and I would say I see that as a kind of a common thread across the market. And for me personally, I mean, I'd be interested in other people's views, but I think Master Trusts are the future for the kind of the UK retirement market. I think they're going to drive innovation, and they are generally a force for the good. That would be my view.
If I can give you my view from Hyman's, is that what we're seeing as more and more money pours into Master Trusts, following authorisation, that performance monitoring and comparison of strategies and all of that sort of stuff on the investment side is becoming more of a differentiator between the different master trusts. So whilst there's probably quite a bit of headroom in the fees charged, so coming back to the previous question about charge cap, we see a lot of the master trusts, their charges for their growth phase funds are between 25 and 35 basis points, so well below the 75 cap. But what we're seeing now is we're seeing more innovation in terms of, bringing RI into the policy, use of target date funds, and just innovation, and maybe thinking about liquids as well. Innovation in terms of investment, and so I think that will start to come out and stand out as one of their USPs, as it has done with technology and financial well-being and comms and things like that.
If I may jump in, I fully agree. It's difficult to imagine small schemes with 15, 20 million being able to access the best asset classes and the most sophisticated strategies. So master trusts for this, in this respect, really bring innovation and also bargaining power. So you can access potentially liquid debt, for example, below the fee cap. Would be more difficult if you were by yourself, simply because you have more assets to invest. Finally, I think there's a point that we'll be talking about later. Master trust can also be some sort of a governance pillar for small guys, to avoid on one side the scams, but also to protect them against all mistakes in administration. And we know that administrative mistakes plague the DC world in general. So really, I think that even though they do spend time on administration, I think it's for the good of the DC members. So all in all, I think they are, really a driving force into the general sophistication of the DC market in the UK. Without them, it's going to be very difficult to help, especially small guys. The big companies which have, let's say, more than 500 million themselves can do the job by themselves. Small guys are really, I think, should rely on master trust much more often.
Right. Okay. Stephen, are there much interest from members in alternative assets, real assets? Because I did read something like 95% of all DC savers are in the default fund, but of course there's a whole world out there, isn't there? So much interest in your side of things?
I mean, the level of inertia amongst Nest members is extraordinarily high, as I'm sure you can imagine. So the degree to which we're engaged on investment matters at all is very limited. And when we are, it's at a very high level, usually reactive to something along the lines of an annual benefit statement, or very occasionally a piece of news. For example, the Guardian's recent campaign to leave it in the ground, to divest from and reduce exposure to fossil fuels. That's the extent of the granular interest that most of our members, if any of our members, take in their pension pots and the way they're invested. So a short answer to your question is no. There's no particular interest from our membership in alternative assets or liquid assets, but that's just an extension of the lack of interest that they have in the way their pensions are invested more generally.
Interesting. Jeff, let's talk about allowing DC schemes to invest in more liquid assets. Is that a good move, do you think?
Well, from the regulator's perspective, we're open-minded about it. I think we're keen to see innovation. I think the point's been made that within DC currently, I think on average over 90% of assets are in the default funds. This seems like it's an asset allocation on behalf of a default fund, which can add to diversification. It can potentially provide other characteristics and qualities that that are positive going forward. So I think we're open-minded about it. Ultimately it's a it's a trustee decision, and they've got to worry about things like value for money and suitability. They've got to think about, you know, a lot of the non-regulatory issues that I think create some challenges from an operational, from a practical perspective of investing in alternatives. But from a pure regulatory perspective, we're open-minded, and I think we're positive about any developments in that space.
Gotcha. And Julian Halfron, have you seen much interest from DC schemes in more alternative assets, more liquid assets?
Yes, we do. One of them is here, so it's more complicated to speak about this. It's easy to speak about this. It's public knowledge, that's fine. Yes, we do. I have to caveat the comment, because there is interest, but there's also a bit of lack of information about what are the ins and outs of e-liquids. I mean, Nest is totally different. They have really invested time, resources, understanding the market. Stephen can talk about liquid debt, liquid private equity, can talk about potentially all those other illiquid asset classes quite easily. But it's more the exception than the rule. So I think that the DC market in general has to do, I mean, there's a really learning curve there, has to make efforts to understand it better. And I think it's also on the side of the asset managers to educate the master trust and others. We've been talking to other master trusts, and we realized that it's also on our side to supply information, explanations on what the liquids do. And given the current environment, I think we have a great opportunity to show the resilience of some liquid asset classes to great market shocks, simply by the fact that they don't have the same sort of link to market volatility than equities or corporate bonds or even government bonds. So there is, I think, an interest, but also there's also lack of understanding and knowledge about the general liquid asset classes, and this is potentially a challenge for the next few years.
Yeah.
And Julian Newton, is this something you're introducing to DC schemes? Are you talking more and more about liquid alternative assets?
Yeah, I think summarising a couple of points. I don't, I'd be really surprised if members are banging the table demanding alternatives. I think it's all about that the default options, about delivering the best risk reward that you can for members, and delivering that outcome, if you like. For us, in terms of the strategies that we use, we try and use. Most of our funds are liquid, being candid, but we try and generate some returns from use of alternatives in those structures. But it's all part of delivering the right return profile. It's all about delivering, the best risk return. So I think anything that can do that has to be looked at. But I am mindful, and we need to be careful with these when we talk about liquids, because clearly there are positives, clearly diversification. But and I know you probably don't describe property as alternatives these days, but when you have a mismatch between the liquidity that you're offering unit holders and the liquidity of the underlying asset class, you need to be mindful of that, which is why I think, linking a few points here, the use of scale, the importance of default funds is important in enabling certain plans, certain schemes to consider the appropriate use of alternatives and illiquid assets. But it's the right thing to look at, but we just need to be mindful about how we manage that mismatch.
Okay, thank you. And Keith, obvious place to go. I mean, are you guys interested in illiquid assets?
Yeah, well, interesting one. So we have a very different, as I was alluding to earlier, different demographics, kind of the Nest demographic. So we have got probably about 20% of our, if we look at our middle management up population, about 20% of those are not in the lifestyle option, in the default option. And they're utilising a range of 15 or so funds. The closest thing we've got currently to illiquid is, as Julian alluded to earlier, is a property fund. It's effectively a fund of funds, and has a significant, like many property funds right now, has a significant allocation to cash as well. But even given that, we've seen 2 or 3 times now holds placed on that fund, which potentially could spook members. It spooks us from a kind of a governance and employer perspective, that if somebody's invested in that towards retirement and suddenly can't get their money out when they want to, that's a bit of a concern to us. But in terms of member interest in that fund, it's actually very low. It's probably one of our lowest. We've got maybe a handful of people who've invested in the property fund. Reasonable amount of assets that they've done, but it's small numbers of people, and they're about the right demographic to be there as well. So they're not the people who are approaching retirement, but if they were, then that would potentially be a concern to us. So that would be the same for any illiquid fund. I think where they potentially do have a place is in kind of decumulation, and where you've got the master trusts who have got the scale to be able to deal with it. I think that the downside to putting in decumulation is that it's based on my assumption that people will be sensible in terms of how they draw down their funds over time. But obviously freedom and choice gives people the ability now to take out larger chunks at random times. So perhaps even might not be the right place for our fund, for example.
I think just to add to Keith's points around operational issues, I think the gating that we've seen on some of the property funds, even a particular active equity fund last year that was suspended, was it last year? But operational issues for DC schemes are a key consideration. So it might be the asset class that suits the demographic and that point in the glide path, let's say, but if your platform provider can't allow access to these funds, if say it's part of a blend and just that very small part, let's assume, is suspended, does that suspend the whole thing? Operational issues will be key. If members can't retire when they want to, if we've finally got them to engage with pensions and they can't actually access things, it will damage the reputation of pensions industry further, I think. So funds still remaining or still being priced at least by some of the providers, which has helped in this regard, but it just highlights for me how key these operational issues are for DC providers.
Just a quick observation on the property side. As I understand it, by and large, the property funds that have had to gate have had to do so because their products straddle both the retail and the institutional space. Is that correct? So a purely institutional property fund, assuming it didn't see enormous outflows, if they thought they were able to value the portfolio accurately or reasonably accurately, would not be obliged to gate. So I think part of the issue is, part of so many of the issues around DC is that it's catering to both a retail and institutional space at the same time, and therefore being caught by the more stringent set of regulations upon those two regimes.
I think one of the other things that's just kind of worth noting is in terms of having illiquids within the DC environment, the kind of industry infrastructure at the moment is not really set up to support illiquids. I mean, Nest is the exception because it has a custodian-led model for the way that it manages its or delivers its assets to members. But a lot of the industry is still dependent on life platforms and life wrappers, and I think that they and illiquids don't sit too comfortably together at the moment. So I would expect, particularly in the master trust space, as assets grow, but there'll have to be a bit of a rethink around how illiquids are put into investment funds and delivered to members.
I'd like to echo what Philip said, in fact what everyone said. I think a lot of this is actually about scale. The infrastructure isn't there, but we've also, I think we're expecting quite a lot of what is a relatively young DC market, and a lot of the schemes have only just started growing as a result of automatic enrolment. And when you look at the schemes that are looking into illiquids or do have sophisticated ESG strategies, they're very large schemes who can afford to still invest in illiquids and maintain cash flow and stay under the charge cap. So I suspect that in the long term, when schemes grow, they'll find it a lot easier to invest in illiquids. And it's really the smaller schemes that are struggling. So access to illiquids either will be through long-term growth or consolidation or pooling. But if we look at Australia, where the market's much more developed because auto enrolment's been around for 50 years, they're not having any trouble investing into illiquids and also engaging with more complex investment strategies. So I do think we're almost quite hard on ourselves because we're expecting a very sophisticated and fully developed market that is actually quite new. So I believe that scale is going to be one of the major issues going forward that's going to unlock some of the opportunities for DC schemes.
I think that's what we're seeing overseas, though. It's the scale of the DC plans. So you look at Australia, or you look on, I think in the Netherlands is similar. You don't have that many schemes relative to the UK. You count the number of schemes in terms of a couple of hundred schemes, not 3,000 or 2,000 or whatever the number we have. The scale is absolutely critical.
Okay, guys, we are over time. And we've had quite a full discussion there. There's a few things we didn't get around to, but just going to show that this is, as Daniela said, this is a young market, it's a growing, developing market, and one I'm sure will continue to influence the retirement savings industry going forward. I'd like to thank you all for your time today. It was good to hear all of your viewpoints. So very wide range of things to talk about in the DC world. I'd especially like to thank BNP Paribas Asset Management and Newton Investment Management for their support as sponsors today. And I thank you all very much and hope to see you all again on the other side of this crisis. Thank you, guys.